This is the Retirement Key Podcast with Abe Abish, founder of Abish Financial Services.
We see a lot of successful do-it-yourself investors, but there's a major difference between pedal to the metal, getting up that retirement mountain, and then descending down the mountain safely into retirement.
You've worked hard your whole life to earn and save. Now you need a plan to make that money work hard for you.
Hang in there, and the markets will come back, and we're in the same boat as you. Is not comforting for someone who is 58, 65, 72, and there have got to be better ways to do things, and there are.
Abe is here to help you unlock the keys to your retirement.
It does feel a little deja vu-ish, Abe, with what we are seeing now in the headlines. And what is this bank situation happening with all of a sudden, banks are going under? How often do you say, remember in 2008 or the situation in 2008, or if you think back to 2008, and here we are with the bank problem again, Abe?
I think I figured out the problem, Heather.
Oh, tell me.
All three of these banks start with an S.
Oh.
Silicon Valley Bank, Signature Bank, and Silvergate. So maybe you should stay away from banking with a bank that starts with an S. Now, that's just a joke. But in all seriousness, all of this manipulation and intervention by the Federal Reserve the last 14 to 15 years, all of this lowering of rates, raising of rates, pumping in quantitative easing, $7 trillion, I think, last year of stimulus, and all of this intervention and intervening causes problems. And here we are, inflation wasn't an issue. A 40-year high inflation, sure, it was an issue. And when you raise rates 8 times in a matter of 15 months, things change. And now we can go and pick up, 4 and 5% in the bank and 6%, 5% on a treasury and 6.89% on an I bond. So why would people, invest in stocks? I don't think the next 5 to 10 years look really well for the stock market specifically if rates stay high. So what happened was, and maybe these few banks, are in an isolated situation with, Silicon Valley Bank, loaning to tech startups in Silicon Valley, and then Signature and Silvergate, lending to the crypto space, I believe. Maybe they're isolated, but I don't know. I have a feeling that this web is going to dig a little bit deeper and that we might see a deeper negative effect. We'll see. We can speculate all we want, but the point is, amid all this uncertainty and all of these things going on, there's no better time than now to get your financial house in order, especially if you're ready to retire or just into retirement. With all this stuff going on, you don't have to be a victim of the stock market itself. Put together a plan. There's a lot of places we can go to where we have safety, Heather. And now that rates have risen, get some decent, safe yields, and some of that guaranteed. The federal government, insurance companies, banks. So there's a lot we can do. Focus on what we can control. Put together a plan for phase 2. A lot going on. Man, there's a lot going on. Focus on your own financial house, on your own financial retirement and plan. Control what you can and be proactive.
Hopefully we will see some containment. Hopefully we won't see a trickle out of other bank domino effects, but you never know. And again, controlling what we can control is always the bottom line, and the work that you do there at the Abish Financial Service offices, Abe. And thinking again, let's go even further into the big unknown zone that is the financial world we live in, because the Federal Reserve will meet again next week, and it's already signaled yet another rise in interest rates. But everybody is wondering, how long is this interest rate rising world we're living in going to continue? So analyst Adam Johnson had this to say on Fox Business.
My opinion is that the Fed is almost done raising rates. Fed fund futures say that the Fed's going to be done at about 5.25. We're at 4.75 right now. So we're within 2 or 3 more hikes of being done. And remember, stocks always look forward by 6 months, which means the stock market's already saying, okay, it's done.
So, Abe, do you agree with this? Does this mean we should hurry to take advantage of current rates on things like T-bills and CDs before they start coming down? What are you recommending?
So we'll see what the Federal Reserve does. I think the market started off the 2023 hopeful that the Fed was done and that the Fed would stop increasing rates. But then again, the Federal Reserve just came out and said they're going to increase their terminal rate. Basically, what's happening is inflation hasn't cooled down enough. It's cooled down some, but it's still high. I still believe it's right around 6%. Last year it was in between 8 and 9, 40-year high inflation. inflation. And so the Federal Reserve seems like it's going to do what it takes to get inflation under control, because this is why we have all this volatility and uncertainty. And so we'll see what's going to happen, but have a plan, right? Have a plan to transition into phase 2. Everyone has a phase 1 plan. Everyone has a phase 1 plan. That's just a big basket of all your investments in stocks and 401ks and TSPs and IRAs and savings accounts and all these things. Few people, I would say less than 1 in 10, because that's how many people we see have an actual plan for phase 2, have the right plan as they transition into retirement.
Okay.
So we just had a couple come into the office. They called into the show. They're from Gainesville, Virginia. They have about $1.2 million saved. They are a 7 on our risk scale. So they're able to handle a decent bit of risk. On 1.2 million, they would have probably 800,000 to 900,000 with us in the stock market itself, stocks and ETFs and growth focused funds. But 30% of their portfolio, they're saying, well, Abe, we're in our 60s. We're just about ready to retire. We want to know that 30% of our life savings, because we can handle some risk, is protected. Either has 100% downside protection or a lot of protections wrapped around and built in, so that when the markets are down, the stock market specifically, we've got something there to soften the blow. The issue is, Heather, as we were talking to this couple, that they have all of their money in the market, stocks and bonds. And in 2022, for the first time in 50 years, stocks and bonds, equities and fixed income, were down simultaneously for the first time in 50 years. And that's because rates rose last year 7 times. And a lot of people know that when rates rise, bond values fall. And when rates decrease, bond values go up. Well, rates have risen 8 times since the start of 2022, and rates are still on the rise. So bond values are still falling. And so that was their main problem. They came to us with $1.2 million. All of the money's in the market. They're paying an advisor currently an investment fee. Nothing's built in their plan to protect on the downside. No plan to transition into phase 2 and help them cross over into retirement successfully. Nothing to address taxes or anything else. Just $1.2 million of investments in the market. And although that's a great job of accumulating and saving, they're realizing, wow, there's got to be something more to retirement planning than just riding the market out the rest of our lives. So they came in, Heather, and they got a comprehensive phase 2 plan, a plan to help them transition into the second phase of their lives. That includes, with us, an income plan, a tax plan, yes, an investment plan, but an investment plan that's more appropriate for someone in their 60s so they can stop investing like they were 40 or 50. A plan for sequence risk. Those are, that's that risk as you're taking money out of your portfolios, that the markets could be down while you're pulling money out. A plan for RMDs, healthcare, and legacy. It's a comprehensive retirement plan for those that are approaching phase 2 or already in phase 2.
One of the many things that you see in review for folks in your office going through this bigger picture process and review is obviously a 401k, a very popular way to save for retirement. Unfortunately, we have the numbers in about how our 401ks are doing, and it's not looking good. According to Fidelity, the average 401k lost 20% of its value last year, and the number of 401k millionaires has dropped more than 30%. Abe, you have talked before about the magic age of 59 and a half, because at that time we now have more options to put this money under our control and protect it. So tell us more about how that works.
Heather, I want the listeners to think about climbing up and down a mountain right now. And we always talk about the retirement mountain and the ascent versus the descent. All of our clients are almost finished with the ascent. They're almost finished with climbing up their own retirement mountain in terms of their working career. And they're thinking about descending down into the second phase of their lives, their retirement, their golden years, or they're about to already have started to descend down into their own retirement years, right? And so as you're climbing up and getting closer and closer and then descending, you want to think about clipping in your gains and protecting the last 30 to 40 years of your climb, of your quote-unquote climb, of your quote-unquote approach to get to retirement. You want to wrap in as much protection around all that work that you've done to help you transition successfully, right? And so that's what I want listeners to think about right now. And so if you have 401ks and TSPs, we just had a couple call in and they both work with Costco. And so they have 401ks there. And I don't believe that this couple realized that they were older than 59 and a half, and because so, they were actually able to move some or all of their money outside of their Costco 401k plans without any penalty or taxation. They didn't realize that they were able to do that. A lot of people that even work for the government and have TSPs don't realize that once they're 59 and a half and older, they can actually roll over part or all of the plan into a traditional IRA or Roth IRA, if it's in a Roth, without taxation or penalty. This is a privilege that the IRS allows once you're 59 and a half or older, because the IRS says, wait a minute, this couple is getting close to retirement. They should have more options available to them outside of their company plans. Well, when this couple from Costco came in to meet with us, they realized they didn't have a plan. They had a growth plan. They had their Costco 401ks and IRAs and some brokerage accounts and savings, but they had no plan to help them transition into phase two. Here this couple is about 5 to 6 years away from full retirement. And we said, you know what? Here's the analysis of all your investments. These are all the reasons why you should consider moving dollars out of your 401k, because although you have some funds there, you can build a customized plan for you outside of your company plans that could be more appropriate for you. So that's exactly what they did. We implemented some transfers, rollovers of their existing employer plans, other IRAs that were being managed outside of our company. All of this was done without taxation or penalty, like-to-like account transfers, many more options for them outside of their company plans. We show them how we can reduce costs for them, provide more opportunity, reduce risk, and basically create a plan that would be more appropriate for them as they transition into phase two. If you're listening right now and you would like that same analysis done for you as we did for this couple, it was a portfolio X-ray and analysis. If you're 55 years old and older and you've saved $500,000 or more for your retirement, and if you're wondering if your TSP or 401k or IRAs are appropriate for you and what the pros and cons of those accounts are for you, go to retirementkeyradio.com, click on the Contact Us tab at the top of the page, and we can begin to have these same conversations with you as well.
Thanks for listening to the Retirement Key Podcast with Abe Abish. To learn more about Abish Financial Services, visit retirementkeyradio.com and join Abe for his radio show, The Retirement Key, Saturdays at 8 a.m. and 2 p.m. and Sundays at 2 p.m. on WMAL.
Investment advisory services offered through Abish Financial Wealth Management, LLC, number 310633, a registered investment advisor firm. Financial professionals are not licensed in all 50 states. To find out if Abraham Abish is licensed in your state, please call 571-577-9968. Abish Financial Services is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Abish Financial Services, Inc., Virginia Insurance License number 127820.